Hey, we met. After reviewing and performing constant research on the current situation our company is facing and the two offers we have on the table, I've come to a more defined conclusion that would be highly beneficial for the company to consider. And so, before I get down to the stats and the quantitative data, I'd just like to provide a quick rundown of the two offers that we have. So, the first deal that Langstaff Venture Capital Fund offered us is $100,000 as an investment in exchange for 20% stakes of our company. And the second deal that we have is $100,000 in debt in exchange for 9% PIK, which is a payment in kind interest, along with 3% equity stakes in our company as well. Now, regardless of these two offers that we have presented, our enterprise is headed in the right direction. Now, taking into account the first 6 months of launch, we generated $300,000 in sales, and we are projected to reach 700K in 2022. So this is a little graph I drew up quickly. So clearly, you can see in the first 6 months we generated approximately $300,000 in sales, and we are projected to hit 700K in 2022. Now, although those aren't the more substantial numbers, but it is an uptrend clearly because we can see that it is going in the uptrend. There is no fluctuation in sales or revenues. It is all going up. And so that is a positive thing for our company. Now, considering we are in a blue ocean market, which essentially means that we're immersed in a market with minimal competition or barriers standing in our way of growing, clearly, uh, it also means that we have also optimized our operating costs by adapting to the virtual environment. Considering COVID-19 and the pandemic we are in, we have simultaneously reduced the company risk as there is no financial commitment. Taking into account many tutoring companies that, like for instance, Kumon or UC Mass, they have places they have leased, they have places they have rented out, and so for that, obviously there would be a lot of financial commitment. There would be you have to pay for you have to pay for the lease, you have to pay for the rent, you have to pay for hydro and all these small little maintenance fees and whatnot. The only fee we have to worry about is the financial commitment towards our employees that work and the wages we owe them. Um, and obviously the 20K that we initially invested in order to create the site that we have up on the internet. Now, obviously, it's about creating and capturing uncontested market space, thereby making the competition irrelevant. And that's what we have done so far. We want to take monopoly over the online tutoring business, and we are currently headed in the right direction. Now, clearly, we want to expand, but we never got the chance to because there was never an incentive to raise capital to begin with because it was an online virtual tutoring company. Um, and so, because of that, we have very little access to equity in the bank. And so, in order to put this into simpler and layman terms, we have no money in order to invest that into marketing schemes and strategies. So, the thing is, the growth is there. However, it's not substantial. You can see by the chart I grew up here, the growth is definitely there's an uptrend, but it's not substantial in terms of numbers. And so, for that exact reason, we were looking for in the venture capital that could help fund our investment in marketing our company and inviting that exposure that we are currently looking for. Um, Now, before I move down to talking about the numbers and stuff, I'd just like to say that we are doing a good job in helping our society and the kids. For instance, your daughter, it all started from our problems. And so, considering that a lot of kids out there are also having the same issue. And so, for that reason, what we're doing over here is a great service to our community, to our society, and to the kids that will become our future selves, or possibly even better. Now, the breakdown of the offers. So, the two offers we have presented, um, I put this in a T chart over here just to make it more demonstratable, more representable. So, you can see the first offer we have is $100,000 as an investment and in exchange for 20% stakes of our company, which is 1/5 partnership that we're giving away. Now, the strength to that is we don't have anything to repay. It's $100,000 as an investment. It's not debt. We don't have to repay the money to the venture capital. We keep the $100,000. We invest that into marketing schemes, marketing strategies, exposure, whatnot, etc., etc. And the only downside which is the major downside, is that we're giving away 20% of our company, which is quite substantial in my opinion. So considering numbers, 700K, we give away 20% of that. That's approximately $140,000 that we're giving away if we were to have that deal before. So this is just to put things into perspective. The opportunity, however, there is an opportunity for that, is that the more investment, the larger the investment, the more invested the investors are into the company as well. That means that more investment equals to more effort, and more effort means more chances of increasing growth in producing the large customer acquisition rate that we want, that we're looking for essentially. Um, and it just means that not only do we have our company and our employees working on this project, we have another company, another venture capital, and their consultants also working on this project with us. So that's the opportunity side in terms of this deal, the first deal we're looking for. The second deal is $100,000 in debt in exchange for a 9% PIK. So that's payment in kind interest, and additional 3% equity stakes that we're giving away. Now, PIK, which is payment in kind interest, doesn't necessarily mean we're giving away 9% of the $100,000 investment in cash, right? So we have to repay the $100,000 within the 3 years. We can do that in a lump sum in the third year as well. So we can give them a lump sum of $100,000 that we make at the third year, or we can divvy it up and give them $33,000 each year, or 50-50, or whatever it may be. The PIK is the payment in kind interest, which could be returned, which can be given to them um, in means of services. We don't have any products, so in services, or we can give them 9% stakes. I mean, 9% in stocks, right? Ideally, in my opinion, I think the best way to give them the 9% PIK is to offer them $9,000 worth of free services. So what we can do is, if the venture capital has, if the people that work there, if they have any kids, any children that need tutoring services, we can offer them up to $9,000 worth of free tutoring services, right? So that's one way to put it for 3 years. So that's about $27,000 worth of free services that we're offering to them for the 3 years, and 3% equity stakes, which is clearly self-explanatory. Um, Now, the strength to that is that we're only giving away 3% of our stakes, which is nothing compared to the 20% that we're giving. That's a 17% increase. Um, however, the weakness is that the 100,000 has to be paid back within the 3 years, right? The opportunity is that there's only 3% equity stakes. Now, considering you also were in the consultant business for 10 years, you probably have a lot of knowledge that you gained that you can always implement into this situation that we're in. And so, in my opinion, I think the best way to take this is to take the second deal, because not only are we, after we give them the $100,000, we are completely free because we don't have to give them PIK. The only thing we owe them is a 3% equity stakes of our final fiscal year and the profit that we have. That's the only time we have to pay them 3%. And also, the weakness also is that when there's less investment, there's less interest, there's less effort from the other side as well. But compared to the profit stakes that we're giving away, I think it compensates that for quite fairly. However, there's always a third way, and that is crowdfunding. Crowdfunding has always been out there, but it's never been implemented. We could be funding our project by raising many small amounts of money from large numbers of people, typically via the internet. And depending on our population and the proposition, we do not have to mention anything regarding returning a certain service or profit. And so we're not obligated to meet that financial statement if we don't make it. And in that case, the funds we raised will be considered as an investable capital and not debt. So that is also a route we could possibly take. However, the caveat is that there's no set time frame in terms of meeting deadlines or even living up to the expected growth. It is all in the hands of the exposure that the crowd fund receives. So obviously, when it comes to closing a deal, it's important that all our clauses and conditions are in our favor. We have a term sheet, and all our possible contracts will be reviewed by our lawyers, clearly. Um, and I just like to thank you for taking the time out of your day for meeting with me. And if you have any further inquiries or anything about the topics that we covered today, we can always arrange another time to meet. And so that is it. And thank you so much.